Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monte, Senior Technical Analyst with Market Rebellion. And yes, we had another wild week. This is a one-year daily candle chart of the Dow Jones Industrial Average ETF. And as I zoom in here, you can see that we did hit my downside target from last week's report. And when I put out the midweek market report, we highlighted that as well. But we closed the market this week with a very interesting group of candles. First and foremost, yesterday we had this red candle on the diamonds, which represents a hanging man. And this long shadow on top of the candle from today, Friday the 3rd, we have a shooting star, very close to a shooting star. You usually see those long shadows on shooting stars at the end of an upward leg, and that's exactly what we have here. So what does that mean for next week? Well, we're hitting on our targets quite regularly. You can see here this was an upside target that eventually filled here. Here was another upside target. Here was a downside target that filled here. Upside target filled, downside target filled. Well, I think we're going right back down. We're oscillating in the diamonds. We are in a market that is absolutely perfect for swing traders and option traders. So as I go out my forecast here, I think next week we're going to go lower. The diamond target right there is 335.20. So take note of that, and we'll report back to you during the midweek report. Now, if we look at IWM, which is the small cap ETF, you can see that I had a two-part forecast on this one. Here's another one where we're hitting quite regularly on our targets. Back here, I said we have an upside target. That failed. And this was a two-part. I said we would go up and then come down. We're far surpassed the upside target here of 191.13. But you can see this green dotted line up top. That's a resistance point that I highlighted. And we have a shooting star today on Friday, again, the 3rd of February. So I'm keeping that downside target on IWM at 186.71. I think we'll move right back down to that moving average, and I'll show you why when I give you my other articles that I'm finding and some of the data that I'm pulling out of the market. So that's the downside target for IWM. If we look at the Qs, ticker symbol QQQ, it basically represents the tech sector. Again, another two-part forecast. We hit the upside target and we hit the downside target, not necessarily in the order that I thought we would, but we're definitely over this upside target of 290.66. We gapped up yesterday on Fed speak Powell, and I believe that the markets are completely misinterpreting what the Fed chairman is saying. And again, I'll give you some indications of why I think we're going to continue lower from here. Today we had a shooting star. This gap is still open, so I believe that gap will fill eventually on the downside, and I'm keeping that downside target on the Qs at 290.66. Our option traders, if you're out there, you know we made some adjustments to take in some cash this week. All is working perfectly well from what I see on my end with our put spreads, and I'll continue to update the member page with trade alerts to follow next week. So that downside target again on the Qs is 290.66. Now let's talk a little bit about the spiders. Ticker symbol SPY. This is the S&P 500 ETF. And this line right here, let me just explain, that was not there last Friday. I added this line on the midweek report, and I did explain to the viewers on Wednesday that I would have to re-explain why I'm putting that down. But we did hit the downside target from last week's report, and I initiated a new zip line here saying that I believe that we're going to pull back. Remember, this was Wednesday's green candle. Thursday, we had a spinning top. Today, we have a shooting star. Again, that is very bearish. And notice how the shooting star is on lower volume. So the decrease in volume on the way up is translated to be bearish. So I'm keeping that zip line in place at 402.51 to the downside from the zip line that I drew on Wednesday. And again, I'll report back to you next Wednesday during the midweek report. Now, I want to talk about the VIX because I'm talking to experts that can't seem to get their head around why the VIX is reacting, or we're seeing a lack of reaction on the VIX. With the amount of volatility that we've seen lately, you would think the VIX would be already up around 25, but it's not. Let me tell you what we have here. This is, again, a projected zip line. I believe that the VIX is going to go up to $20.27. We already hit my upside target from last Friday, and then as soon as we hit that target right here, we had a bearish engulfing on the VIX, filled the gap. Now that that gap is filled, I think we're going to go right back up. So my forecast on the VIX is $20.27. One of the reasons that we're discussing as to why the VIX is so suppressed is because we still have a lot of option premium being sold, because investors, especially long-term buy and hold investors, they seem to be selling calls against their positions to try to capture premium and cash to their account to make those investments a little bit better. And I often talk about and promote dividend plus strategies, which is where you get into high dividend stocks and then sell calls against those shares to more or less enhance or increase the synthetic dividend on the position. I'm not going to get into that right now, but we do believe that that's one of the reasons why the VIX is so depressed. I don't think it's going to stay down there because we're already at about one standard deviation below the average of the VIX since 1984. I was talking to my partner, Bill Johnson, about this earlier today, and we both agree that the VIX is oversold and could move higher from here. So remember, if the bullish VIX is showing signals to the upside, then that is definitely bearish for the S&P. Now, let me take a look here at the candles that we have right here. This is a representation of what's happened in the past with the S&P 500 after the Fed has come out to make their announcements. And you can see back here in November, the S&P dropped after the Fed meeting. Right here again in December, after the Fed spoke, we had a bearish engulfing candle right there, and then we had a pretty hard sell-off right up until the end of the year. I think we're going to see that happen again here in the VIX. With the VIX going higher, I think the S&P could drop. So, again, this is just a word of caution. Remember, I'm not a perma bear. I look at the charts, I read the charts, and I say, this is what the candles are telling me, and that's all I could do for you. My long-term outlook, my extremely long-term outlook, and I say extreme, that's 12 to 18 months, is still very bearish. I know there's a lot of people trying to sound the trumpets and saying, oh, the bull market is back and the bear market is over. Let me bring your attention back to last week when the GDP report came out. While many of the analysts were sounding their trumpets, I'm still sounding the alarm, because what's happened here, this is a warning sign that a lot of people are ignoring. And this is what I'm talking about right here. The last time we saw real disposable income drop in the rate at which it dropped last year, remember, we fell over $1 trillion in 2022. The last time that happened, and we had that kind of a decline, was literally during the peak of the Great Depression. Again, no one is talking about this. In addition to that, we have a yield curve that is inverted, and it's inverted to the point where we haven't seen anything like this since 1981. So an inverted yield curve, for those of you that don't really know what that means, it means that we're heading full speed ahead into a recession. So an inverted yield curve gives us a signal that a recession is imminent. All right, so keep those things in mind. Remember, the disposable income, we have the inverted yield curve, and then remember, I keep talking about the dollar, and while the dollar did rally today, you have to understand that Russia, China, they're still attacking the U.S. dollar. I do believe that the petrodollar is going to be a thing of the past. We're looking into the future at possibly petrogold or the petro-yuan. And you can see that Russia has already converted their currency or linked their currency to gold. China is going to be doing the same thing. And I think OPEC eventually is going to be selling oil in other currencies backed by gold. Now, I don't think they're going to say, okay, this is going to be an exclusive practice here. But I think once they start accepting global currencies outside of the dollar, I think the dollar is in big trouble. Now, I want to talk briefly about this, and then I'm going to wrap things up for you. Right, you've heard the term scared money. And while I've always made it a point not to use a double negative, this is how the saying goes. Scared money don't make no money. Well, what causes scared money to have that kind of an effect where we're not making any money? Well, the fear of taking action can cause investors or traders to do nothing. And obviously, you're not going to make any money if you're doing nothing, right? That inaction causes you just to sit it out and watch the opportunities pass by. Now, related to that, you can see that too much fear of losing money will lead you to not put any money at risk. And again, you're passing up on opportunities. This is what I see coming from most of the members that I deal with. Most of the fear arises from a lack of faith in the method or strategy that you're using, or a lack of faith in yourself to execute the process with discipline. So if you don't have a risk management discipline, it could lead to trouble. If you'd like to learn more about how to eliminate that fear, trade with confidence, and put a good risk management plan in place, just go to the link below. Click on the Market Rebellion website link. Contact one of the representatives, and they'll plug you into what I do each and every week. I have webinars, trade alerts. I have conversations with people one-on-one in group sessions. All you have to do is plug into the Market Rebellion community, and someone will help you. Remember, fear is just going to get in the way. Confidence, I've always believed this, that confidence works in direct proportion to your profits. So in other words, if your confidence is up and your fear is down, most likely that's going to lead you to higher profits down the road. So thank you so much for liking and sharing and commenting. We approached almost 200 questions, and I did my very best this week to keep up with that. So keep the questions coming. I'm encouraging that. That interaction helps us all together as a group work through this volatile market. And again, you have a great weekend. I'll talk to you next week. So long.
There's no more damaging formula than to mix emotions with money. Listen, we're made up of emotions. We have fear, we have stress. The trading checklist helps take that all away. And now, wow, take a deep breath, relax, and enjoy the ride. You might be completely foreign to technical analysis. You may not even know what a bullish engulfing candle is or a shooting star. That does not matter. The great thing about what I'm showing you right now is I'm taking 40 years of experience here, and I'm breaking it down to 7 points that you can follow through a trading checklist. Look at any stock, any ticker symbol, using the 7-point checklist that I have, and determine who is in control of that price action. I'm AJ Monte, and this is my 7-point trading checklist.